Hello traders out there in Traderland, welcome to the weekend edition. My name's Des Woodruff and I am your mentor and analyst here at Grok Trade. This video is good through Sunday, January 23rd, 2011, and somebody has asked me to review gold. I'm going to do the gold iShare here, and before I do, I'm going to be moving extremely fast, teaching a lot of things, so be sure to keep up with me. Thing I'm going to show you here is gold's very weak, and I'm going to show you why. This is technical analysis I'm going to teach you. Look at the slope of these two swing highs. Now look at the slope of those two swing highs. Now look at the slope of these two swing highs. This is a rolling over. And this rolling over shows a slowing of momentum. And this is a reversal pattern in the making. Let's blow this back up. Anytime you see that, know that bad things are coming. And we knew back in early December that we had a problem. We quit hitting that level right there. Do you see how we missed it? The stock could not get back up there, or the ETF in this matter. So the other thing I want to show you here is the trading range that we're between. If I were to drop a couple lines between 130 and 140, and it's not perfect, but look how many candlesticks fall between 130 140 area. We are toying with dropping below this. We're below the 20-day moving average, the 50-day moving average. Now we're below the 100-day moving average and looking to drop even lower. If we were to, let me drop this to about, oh, let's see here, 130. I mean, we're so close to dropping below. So there's the trading range. There's the rolling over. Let's get to the markets. I'm going to start off with the Dow. Now, before I do me a huge favor and do yourself a favor and do your friends and colleagues a favor by sharing this video. If you would be so kind, share the video because people need to hear what's happening out there in the markets. Now we're going to start off with the Dow daily. We're going to look at the weekly, monthly on all major indices. I just want to take a look at this. The thing I want to point out, as I'm going to be looking at a lot of technicals here, is the blue moving average line. Okay, now look at this blue moving average. That's the 20-day simple moving average, and look how, I mean, we're pretty far away from that blue line. We're still heading northbound. All looks well. We are now above, I mean, we remain above the histogram zero line, so things look fairly strong. Let's go to the weekly. The weekly chart, we're going up, 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 up. Look how many times, I mean, 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row. That is a huge run. Getting ready to hit a resistance area. The question is, can the Dow get to 12,000? I mean, we're so very close. And here's the other thing. If you look down here at the CCI, it's the Commodity Channel Index. I'm using a filter of 20. We are up here in the what's called overbought area. So the markets are overbought. And that was my Android phone ringing. And video is too far long for me to change. So remember, we're looking at the monthly Dow here. We're nice uptrend. We hit the uptrend, or the upper trend line. We hit the lower trend line. We're heading back to the upper trend line. But we're up several days so far. 1, 2, 3, 4, 5, and 6 months in a row we're going up. 6 months. And if you look down here at the stochastics with the filter of 14, we are yet again in the overbought area. So the markets are just overbought, overextended, when all these oscillators that I'm showing you here are measuring overbought, or giving us overbought indications. Now our next level of resistance here is right at 1286 as far as the monthly is concerned, but we have 12,000 right here. And when I say 12,086 is this line, and then a big one at 12,255. I just don't know if we're going to get there. We might not. But here's the question. If we go up at this slope right here, when will we ever hit this upper trend line? Let me draw a line from just the highs here. Okay, if we go with this logic, we're up a number of bars, right? We're up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, I mean 20 bars. Is there any chance for it to go up 20 more bars or 20 plus bars? There's very little chance of that happening. My only point here is it's going to stop here, somewhere short before the markets finally have to give back and to pull back. When that happens, you will now have a rising wedge formation because it will drop. Let's say it drops right here. Another trend line right there would give us this formation. You can kind of see it how I'm drawing this rising wedge. That would be not very good for the markets. All right, let's go here and look at the S&P. Remember, I said to focus on the 20-day simple moving average. We had this nice tight channel. We're going up, high base formation. We broke out, a bull pullback with a hammer. We rallied, another pullback. But here's the problem. There's a text message coming in. Here's the problem. I shared it with you on Thursday's video. We close lower. We close lower than the trend line. Ouch. That is a big time problem. On Friday, time that I'm doing this video, we tried to rally north to heal itself, to get back over that trend line. But by day's end, rounding out the week, we come right back down, closing below that trend line. That, my friends, that is thunder in the distance. This smells like significant trouble. The other thing is I thought we were breaking out of this big gnarly, see this big, if I were to go back, let me show it to you. We had this bearish divergence taking place. We're going up here, going down there on the MACD, and we're breaking out of it. I said we needed to bust over this high. You remember me saying that? And instead we dropped back below that line. This is flirting with the histogram 0 line. It's been a while since we've been below that, but bad things can happen if that were to take place. Let's bring the weekly in. Here's the weekly. The weekly is going up, 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 up. All looks well, right, with the trend line. But we're stalled. We haven't hit this trend line. We're not strong enough to get to 1300. Actually, we have close to a tweezer top, but we definitely have a bearish Harami pattern. A bearish Harami pattern. And if you look down here at the CCI, we're overbought. Well, of course we're overbought. Look how much we've been running here. So we are definitely looking at a chance of dropping. And one thing that I didn't show you, look at the 20-day moving average. This 20-day moving average, we touched it on Thursday. Do you see that? We touched it. So the Dow, we're way away from it. The S&P, we touched it, and we're flirting with coming back down to that. So I want you to keep that in mind because I'm going to build a point here in a little while. Here's the monthly. The monthly, we come up, we drop, we're rallying up. So let's see, we're up 1, 2, 3, 4, 5, 6. We're at a resistance area at this 1283. And I mean, that's right where we're at. We closed right at that area. But the question is, will the S&P go up 1, 2, 3, 4, 5, 6 more months or bars in this case? We've already been up 6. Will we rally another 6 months? As far as the stochastics are concerned on the monthly, we are overbought. Last time we were up here at these levels, we crossed over and dropped, and we had a significant pullback at the beginning of 2010. If this happens again, we won't be looking at this line. We're going to be looking at a line similar to this. So look at this line and this line. Do you see these two lines? That's a rising wedge, and this thing could get I mean, bad things can happen with a rising wedge, especially on a monthly. So this is something we are watching very close here at Grok Trade. Now, I want your eyes to be open. I'm looking at the Nasdaq here. The Nasdaq had this big rising wedge with this huge bearish divergence on the MACD, right? Look at the 20-day moving average. We're below it. We closed below the 20-day moving average. The last time that happened was back here, and we had a big sell-off. I mean, it was a big gap down, and then we rallied back, got choppy. It was just a nightmare area right here, and then we finally took off. Now we're there again. And check this out. If I blow this up, we are flirting with dropping below the zero line on the MACD. This is big time trouble. So the Dow was far away from the 20-day. The S&P is flirting with the 20-day moving average. The Nasdaq is now below the 20-day moving average. Here's the weekly on the Nasdaq. Again, share this with your friends, all your colleagues, trading buddies. And you hedge funds that watch me, it is so important to have a technician working for you. And having a technician on your side helps you know when to safeguard that capital that you work so hard to build up. You don't want to be giving it back. And there's some key signs you all need to be watching here. Now, on the weekly, check this out, gang. Tweezer top, we're at a resistance line, and we have this big, just horrible looking bearish harami, and it's a big fat one too. This is a big bearish harami, and this does not look good for what's to come. So my question to you is, when you look at this formation, if you've been trading for any time at all, does this look like it's getting ready to go down, or does it look like does it look like it's going to be going up here? Well, to me, it looks like it's going to be going down. I mean, even here, when the markets were hugely bullish, we only went down 1 bar, but nonetheless, that was a significant drop in the market at one point. There's a lot more room to drop here because here we have this massive trend line coming down that helped give us support. Market stayed bullish. We have the Feds buying up all those government bonds, which is hard to get the markets to drop when they keep buying those bonds, but they've already committed themselves to $500 billion worth of purchasing through June. So if we get a drop, could the drop bounce? The answer is absolutely, especially when you have that sort of behind the scenes activity taking place. Well, here's the monthly on the Nasdaq. We've gone up a number of months, right? Now check this out. What is this formation called right there? What's this called? A lot of people would say it's a hammer. It's not. Because the hammer, you have the body at the top. Well, some people would say that's an inverted hammer. No, that is incorrect. An inverted hammer is only at the bottom of a leg, not the high of the leg. This is called a shooting star. So if you said shooting star, you are right. Shooting star is bearish if confirmed, meaning that we get a lower low. The low for the month so far is 26.63. And, you know, if going into February, we go lower than that, if we maintain that low, that could be significant problems. Because, again, instead of being in this nice uptrend, we will stop early from hitting that resistance line, and you should see a rising wedge come into play on the Nasdaq. All right, let's go to the Russells. These are the small caps, meaning that capitalization is under $2 billion. Nice uptrend, went into a rising wedge with a big gnarly bearish divergence, and we crashed below that trend line. But look at the 20-day moving average. Not only did we close below it, we had been below it for the last couple trading days. And look at the gap down we received on Thursday. Friday, we continue to make lower highs and lower lows. Next area of support is going to be around 764. So, and look at this on the histogram. The histogram's got negative ticks, but we are tracking below the zero line. Gang, here's the point I want to make overall. And I saw this in 2007, and I was screaming that there is thunder in the distance. Be there, be ready to protect your money, and then the markets fell apart because this is what I saw. I saw the Dow going up, making new highs, and I saw the Russells dropping significantly with the Nasdaq close behind. Right now in today's market, we have the Russells down quite a bit, lower than the 200-day moving average, with the Dow, let me go to it, way above the 20-day moving average. Do you see the difference? Let's look at the Nasdaq. The Nasdaq is now below, for the first time in many days here, below the 20-day moving average. The Russell's is significantly below the 20-day moving average. This is a chink in the armor. This is a wake-up call that I want all of you to pay significant attention to. This is far too important. We've worked too hard to make our money up until this point. Let's not give it away. So I'm one that loved to play small cap type companies. The V newsletter, if any of you subscribers that are part of that, you know that they're all small caps. Why? Because those give me the biggest run. So the V newsletter is just my stock picks, V newsletter for the week, and those guys are on shaky ground right now just because of what we're seeing here in small caps on the Russells. The Russells really reflect the type of stocks that I like to trade the most. Now, but when you get bounces, these guys will bounce significantly, making up a large part of what they lost if the market stayed true to a nice bullish move or momentum to the upside. But right now, what I am seeing technically, and as a 13-year veteran in trading in the live markets, what I'm seeing right now is a warning, and my warning is going out to each of you. Be very careful out there in the markets, and be looking for big volume on these drops. If I go here to the spiders, and you could see that during, I know I got a lot of lines here. I use these for intraday on my pre-market videos, but look at the last 3 bars, how we've been going down, right? Look at the volume increase on that selling pressure. That is not to be taken lightly. Watch that like a hawk. Hey, some of you guys like Apple, right? Let me show you Apple's chart here. Apple is crashing and burning. We just broke below a major trend line. Let me show this to you. Support, support, support. We crash below it on significant volume. Okay, significant volume. Apple's in a lot of trouble. We're below the 20-day. We're now heading towards the 50-day. The histogram is now sub-zero on the 0 line. Now, if you have an iPad and an iPod, you have a Macintosh, chances are you have iTunes. Maybe you don't even have an Apple, but you still use iTunes. We have a podcast. I want you to help me out with something. Let me show this to you. Open up your iTunes, sign in, and then click on iTunes Store. I'm not selling anything, and this is free. This is how you can be part of a podcast, but I'm going to give you a gift. If you want a gift, all I'm asking for is for you to do something. So come over here, type in Grok Trade, okay? Type in Grok Trade, and I should pop right up. When you do that, click on this emblem. When you click on it, the screen will turn black. There it is. And see all these reviews down here? We have a number of reviews taking place down here. And this is what I'm after. If you'd be so kind, if you come down here, rate me and our videos, and leave a review. If you do that, all I'm asking you to do is go to the website, go to the Contact Us form, and say that I left a review on iTunes. If you do that and give me your address, I will send you a gift. My last gift I sent out was a coffee mug with our logo on it. But if you want a gift, please do that for me. The other thing that I want to ask you to do is, seriously, let's get back to the charts here. Share this video with your friends. This is huge. And for all you at YouTube and those on my website right now, give me a thumbs up down there below. If you'd be so kind to do that, I'd appreciate that. Take care, and don't be a slacker. Go through the 101 videos. It's 4.5 hours worth of education, free education. It's too hard to make money out there in the markets, and there's too many lazy traders out there. Don't be one of those. Take off the amateur hat, put on the professional hat, and just quit thinking like an amateur and get the right trading education. Do so by going through those 5 courses, and they will help you in your trading. Take care. Safe trading to each and every one of you.